Today, we're going to be watching a video called Investing Backtest that made me sad. Now, we just spent all summer long working with an on-staff quant to make our trading plans the very most profitable trading plans I've ever seen in my entire life. We have big winner, bigger winner, and mostest biggest winner in our trading plans. And I am so stoked to be enacting those. And we do those live every afternoon in the invitation only live streams. And you can join in by joining over at OVTLYR.com for just 82 cents a day. But we're going to be watching this video here about backtests that made him sad. And this is exactly how our quant was working on staff to make us the best trading plans possible.
Like looking at investing backtests to see all the simple ways I could have become a millionaire in the past few years. It's an incredibly sad hobby. Okay, like
Hang on. So Scott, he put one of these together for Plan ETF. I don't know how quickly I could find that, but it was in fact, hold tight real quick. So this is one of our trading plans that our quant Scott put together, and the red line right there is what we're calling Plan ETF. And you can see the initial starting capital here of $100,000, and within 5 years following this plan, hitting nearly $1 million. 5 years, basically 10xing your account within 5 years following this plan. Now, I get why people look at this and that makes them sad, but at the same time, it's like, this is opportunity. Do you not understand the opportunity you have in front of you? Let's keep going.
few years. It's an incredibly sad hobby. Okay, like hindsight is 2020, right? You know, it's funny, you can read about the psychological reasons why hindsight is 2020, but it really doesn't make you want to throw yourself off the top of a Starbucks any less. I don't know why. It's kind of ironic. The first piece of investing wisdom most people learn is that past performance doesn't predict future results. The kind of insurance policy plastered onto every chart with a line going up. Add, I'm not a certified financial advisor, this is not financial advice, and you've armed yourself with the
And I'm just a random guy on the internet. Don't you dare listen to a single word that I say.
tools to say whatever you want with zero repercussions online. Yes, past performance doesn't predict future results, but what's the alternative for predicting future results? Fucking economic forecasts? That's like having to pick between the electric chair and, well, economic forecasts. Aren't those also based on the past? Past performance is not a reliable indicator of future results. So what is all of this research for again? It's like we're going to build all of this research on this one fundamental assumption and then tell you that assumption is not reliable. Maybe you could research something that is a reliable indicator of future results. I'm joking. Obviously, the past is the most reliable thing we have to go off of, and it's more of a legal disclaimer for any misled investors who think good returns in the past means good returns in the future. I just think it's funny when you get down to what this statement is actually implying. None of this actually matters because the fundamental assumption this is all based on is somewhat unreliable at best. But here you go. Didn't Churchill say those who fail to learn from history are condemned to repeat it? Maybe we can just stop learning about the stock market and then it will repeat the returns of the last 10 years. I don't feel funny today. Everything is so simple in hindsight. I wish I could just live in hindsight. How much easier would that be? The economy in the past is a simple system. Causes and their associated effects appear linear, obvious. It's almost like you can draw a line between them. The economy in the future is fucking chaos. Doesn't the Shiller PE ratio predict negative market returns anytime it's above 25? Well, that model is outdated because it doesn't account for changes in interest rates.
Okay. So going back to that kind of stuff, right? This is one of those things where it's like, correlations may have existed in the past, but you don't necessarily want to trade on those correlations, right? You need to look at the data that's in front of you today, right? Because even with this backtest right here, right, that doesn't mean that I'm going to blindly just be like, okay, well, set it and forget it. No, of course, I'm going to be watching my portfolio. I'm going to be making sure that I'm following my own plan. Don't you dare follow a plan from a random guy on the internet, and figuring out what works best for me, right? And things like this, right? Correlations may have existed in the past, but doesn't necessarily mean that they do now. So you need to take defensive measures always on your portfolio.
model is outdated because it doesn't account for changes
But
in
shouldn't we
interest
price
rates.
and show
Kathy
how
Bush
to
doesn't
decide?
know. Belief in one's ability to exert control over the environment and to produce desired results is essential for an individual's well-being. It has repeatedly been argued that perception of control is not only desirable, but also probably a psychological and biological necessity. Isn't it funny how your brain will make every attempt to find control in things that are fundamentally unpredictable just to keep?
That's interesting because so I worked with a psychologist for years, and this was specifically something that he and I talked about for a long time. Is, Chris, you're trying to exert control over the market. You can't do that. Like, you cannot control the market, but you do have control over the entire trade. How can we break that down, right? If I don't have control over the market, how can I possibly have control over my trade? Number one, I choose when to enter. Number two, I choose when to exit. Number three, I choose how big of a size that I put on at entry. Number four, I choose how much I get to watch the trade, right? There are all of these things that are 100% completely in your control. And yet, if a trade doesn't go against them, people think, oh, the market makers are out to get me. It's rigged. Somebody out there did a short attack or whatever stupid crap people come up with, right? Some trades work, some trades don't. Rather than trying to come up with any excuses, just accept the fact that some trades work, some trades don't. And when you can just realize you have control over the entirety of the trade, but you have to relinquish control of what happens in the meantime. Now, that can be really difficult for people, but you can't control the market. So even if you just, get a genie in a bottle, he's going to be like, bro, I can't control what the market's going to do. All I can do is tell you when to enter and when to exit.
Keep you from self-destructing. Like, you'll much sooner draw magical bull patterns on a chart than admit, maybe I don't know what I'm doing here. When I venture out into the world of investing backtests, I like to keep a few things in mind. What appears in retrospect to be simple cause and effect is actually more like this. And the defining question of all of this is, why do the line go up? This one goes up around $11.9 million. This line is the theoretical growth of 100,000 into over 11 million in 10 years. Compare that to the S&P that returned 300% in the same period. I'll link this in the description if any of you want to read it. They basically backtested an index put spread strategy starting in January of 2010, combining different long and short strike selections, days till expiration, and stop losses. You could theoretically recreate this massive return. The strategy is simple. You could even do it in Robinhood. Take SPY, multiply its current price by 0.92, buy a 7-day put at the nearest strike, then sell.
Okay, hang on. I didn't know we were going to be talking about selling puts here. So do not even think about selling puts.
The furthest out of the money put strike that allows you to collect 3% of the position's max loss in premium. Set a stop loss at 5% of the position's max loss. This should turn 10,000 into roughly 1.1 million in the next 10 years, right? But wait, we're neglecting our defining question. Why do the line go up? Take 50 variables, test random combinations of them, and you're bound to find something that looks like a money printer. Technical astrology analysis backtests are usually the biggest perpetrators of this. Business fundamentals are the opposite of technical analysis, and reading the daily upside has helped broaden my business.
Hang on, we're skip the ad read here.
And you can always unsubscribe if you don't enjoy it. Despite the many jokes about technical analysis I've made on this channel, I don't like to entirely rule out anything. You can find a lot of technical indicator strategies that show promise, but it's often difficult to explain why the line do go up. This 12 million% return is a great way to demonstrate how backtests can be misleading. This one was intentionally...
Right here. I'm actually really glad he put this up. So a 12 million% backtest, right? So this is what's called overfitting the data. Okay. So I don't know any of what this is right here, but I'll tell you for sure the likelihood of you actually stumbling into finding this and then executing on that plan is so exceptionally low. That is what's called a fragile overfit backtest. And so one of the things that I worked on with Scott over the summer is in fact, we went over this multiple times. I said it has to be anti-fragile. What does anti-fragile mean? That means that if you are in a situation where it only works on the 9.5 EMA crossover, it doesn't work. Now, why would it not work on the 9.5 EMA crossover? Because we're getting so specific and so direct that it's literally never going to happen. So that's why you need to have an anti-fragile approach to the market. You know, a 10 over 20 price over 50 is a bullish trend. Does it have to be 10, 20, 50? No. Could it be 8, 17, and 43? Yes, of course, because it's the principles behind it, not the specificity behind it. Now, that is a big difference here, right? Having the principles, it's the difference in being accurate and precise. Precise meaning you're hitting the dartboard exactly, perfectly, exactly right in the bullseye. Not even like in the red circle, but like in the middle of the red circle perfectly. Accurate means you're in the ballpark, right? You're hitting in the target area. You're at least on the board and you're in the area of that happening, right? You don't have to be precise in trading. You really don't have to be precise in trading, but you do need to be accurate. You do need to have the idea of being in the ballpark and not just being like, you know, super pigeonholed in this case right here. So overfitting your data is a possibility. And that's why when you are building up a trading plan, always think of it from a anti-fragile perspective.
The overfit to produce huge outperformance. Using a cluster of technical indicators was able to generate almost a 70% compound annual growth rate. One workaround for solving this overfitting problem is testing using out-of-sample data. For example, you take 10 years of Amazon's intraday stock data and use the first 3 years of it testing the Jerome Powell bull ride formation. If it beats buy and hold, test its performance using data from the 4th year. You then repeat this process until you have a breakdown of in and out of sample performance. While still not bringing a clear answer as to why the line is going up, this prevents your model from getting fitted to the noise of your dataset. The backtest should be a method of validating the already sound principles of a theory, instead of a method.
Okay, that's what I just said, right? You're looking for the principles and not the specificity of any one particular setup.
Of finding an edge. For example, testing random historical RSI parameters to see what works might not be a good idea. Instead, maybe your theory is that the top 5 mentioned companies on Ape Wisdom
Hey, I look at that all the time.
experience more momentum because retail interest evolves into echo chambers on social media. You could use the RSI at different levels to measure that momentum, but the actual theory is the important part. There's this hedge fund, Artemis Capital Management. They have some publicly available research about crippling deflation, runaway inflation, the implosion of the global economy, you know, the usual stuff. I'll put a link in the description if you want to read it, but there's another really interesting idea they put forward. Everyone you know who's interested in finance has existed in this window of prosperity. Forget the past 10 years. Even the past 40 years have been a really unique period of economic development.
It's amazing to think that the last 40 years have been one of the most explosive and incredible periods of asset price growth in human history. To understand this, think that over the last century, 91% of the gains of a classic stock bond portfolio have occurred during the 22 years between 1981 and 2007.
Beyond that, looking at the age demographic that watches this channel and most of the finance content on YouTube makes you
I am not in this bell curve right here. At 39, I'm on the old man side.
realize that a lot of us have never been legally able to invest in anything but the greatest bull market of all time. So while it's interesting to look at these back tests, I can't help but wonder what happens now. The past appears to be a predictably unpredictable predictor of the future. In hindsight, things look simple. In reality, the only certainty going forward is uncertainty. I feel like there have been a lot of words in this video, but nothing has actually been said.
So that's one of the things, and we'll stop that video there. That's one of the things that, so I've been reading through the psychology of money. Started off pretty slow. I didn't love it so much. Now I'm about 3/4 of the way through it, and I'm like, oh, let's go. One quote that I picked up on yesterday is plan on your plan not going to plan, right? A successful trader will plan on his plan not going to plan. The reason being is that you must have a stop loss. You must be position sizing correctly. Because if you don't plan on your plan not going to plan, why would you ever position size anything less than full portfolio, right? Why would you not? I mean, if the only thing that can happen is that you will win, go all in, of course. But we know that we're not going to win everything, right? We know that even when we look at back tests like this, there are drawdowns. There are drawdowns, right? Line never goes perfectly up. Line never goes perfectly here to here. Line never goes perfectly from here to here, right? There is all kinds of zigs to go along with the zags. And so because of that, you must be defensive. All stocks are bad, but every once in a while they act right. Your job is to find characteristics of when it is acting right, repeatable characteristics, not just, oh, I have a theory, let's see if it plays out. You need to look at the data, and the best way to do that is by keeping your own traded log. And then at the end of the year, at the end of the month, at the end of the whatever, you take your losers, you take your winners, and you say, what are the characteristics of these winners? What are the characteristics of these losers? Are there any similarities, and where are the differences, right? When you can separate one from the other, and you can see patterns, if you want to think about it that way, patterns in the data, and then you can apply that to say, you know what, when I have a winner, I can see X, Y, and Z happening. When I have a loser, I can see ABC happening. You as a trader need to be aware of that, right? You are Sherlock Holmes, right? If you want to solve how to make more money in the stock market, you need to be investigative to your portfolio. What is working? What is not working? Do more of what is working, do less of what's not working, and repeat. And then you can come up with situations like this. And you have to have theories, and you have to test those theories. And that's why having a quant on staff was amazing, because I would throw theories at Scott so hard, and I'd be like, test this, test that, test this, test that. And the data that Scott would come back with would surprise me all the time. I think that in fact, I need to go count, but our exit signals are about 1/5 on Plan M, 1/5 as few exit signals. And Plan M is about 1,000% more profitable than what I had before that. And it's like, what are we doing here? This is amazing, right? Most of everything that I was doing that I thought worked turned out to not help me, turned out to actually hurt my performance. So pretty crazy, right? So that is the important part of having data, having backtests. And I know that it can be daunting. You can be like, well, I don't have a quant on staff. That's okay. Come up with the plan, go into any charting platform, and then you can just plot it on the chart yourself. Now, does it take time? Yeah. I have videos of me going 3 hours deep manually backtesting something because I wanted to know the answer. And I was hell-bent on finding that answer. And then I got an answer out of it. But don't go into it with a bias, go into it with a theory. Think about like the scientific method, right? Have a thesis, and then go see if that thesis plays out. And if it doesn't, that is a result. If it doesn't fit your thesis, that is a result. So I want you to be successful. And the best way that I can help you be successful is by heading over to OVTLYR.com, picking up the annual pass for just 82 cents a day. And then that'll allow you to have full access to the OVTLYR platform, as well as be able to attend the daily invitation-only live streams where I am trading live and will be trading live and winning the U.S. Investing Championship in the Options and Enhanced Growth Division for 2026. Now, if you're ready to save time, make money, and start winning with less risk, you should click one of these two videos and have a fantastic day. We'll talk soon.